Ready
Great.
to go?
Okay.
Jake, maybe we can start while we're waiting for people to plug in our co-living event. I think in a month from now on April 7th.
Yeah, Rio, why don't you start by plugging that event? This is Rio Shida in San Francisco, and
yeah, so we have an event on April 7th about kind of co-living. It's been the buzz in multifamily for the last 5 years or so. So we have one of our members, Eli Sokol, who's part of Star City's development team, as well as the senior VP of real estate development there, Payal Gandhi. I think I'm pronouncing her name right. Actually, Chris Fraley has been working with them potentially on a couple projects. Anyhow, we're doing a kind of a co-living 101 and just kind of going through the industry to actually perform better than most expected, and not only better than expected, but better than actually multifamily investments in New York and San Francisco, for example. Anyhow, we're doing an event at 1 p.m. Pacific on April 7th, which is a Wednesday. So we'll send out another email and another link for that. And then Jake, you want to maybe talk about potentially we're gathering up capital markets panel on sometime in May. And so if folks on this call know anyone who would like to be on the panel or think would be good folks in the audience, just wanted to plug that as well.
yeah, so at the beginning of May, we're looking to have another one of these panels, except focusing on capital markets, then later in the summer, hopefully having one specifically with regards to debt markets. So we're reaching out to the moderator and a couple other people right now to see. But if you have any recommendations, please let us know, because we're always love to have new people up here talking about the market and where everything is going. But on that note, let me introduce our speakers today. So I'm Jake LaJoie, work for Frost Chaddock Developers, do acquisitions. We build moderate income housing here in Los Angeles. This is James Frost, the principal. And I've worked with Chris Fraley as well, where we worked on a project in San Francisco. And I have the pleasure of moderating the following individuals. So we have Lynn Hackney, who does development in Miami and Washington, D.C. area, and comes extremely highly recommended by Chris Fraley. We have Mo Vela, who has his own consulting firm. He specializes in cultural customization, which, what Mo told me yesterday, if I can summarize it correctly, if you're going to build an apartment building or own and operate apartment building for the Latin community, make sure, you cater to that community. So only white walls, right, Mo? Only tennis courts, only places where you can park your car and not work on it. Wasn't that what you said yesterday?
Something like that, Jake. That was, you're getting warm.
There we go. And then he also has written a book. It's called Pink and Brown in the White House. It's about his time that he served under the Obama administration. And we, representing New York, we have Tom Lucid, who's at Silverstein and currently working on 5 World Trade Center and a development in Las Vegas, and has also wrapped up a multifamily project at 30 Park Place, which is a mixed-use a condo and hotel. And last, but certainly not least, one of my favorites here in Los Angeles, Tom Safran. Tom develops affordable housing. I can't keep track with the number of units that he has under his company's umbrella, but it's not a small number. And one of the things that everybody knows, at least here in Los Angeles, but Tom will never talk about, is how his affordable housing units are the nicest. He always goes above and beyond to make sure that the units are finished out in beautiful finishes, and the projects themselves look fantastic. You would never know These are affordable units. So I've given the 30,000 foot introduction. I'd like to thank all the moderators for participating. I'd really like to thank Rio as well for setting up the technology aspect, for which if he didn't, we wouldn't be here. And there's a lot of work that goes into that. So thank you very much, Rio. And I'd like to thank Chris Fraley for thinking up this idea and for bringing what was Greg and is now El Greg out to the West Coast. It's been a fantastic networking experience for all that are involved. So now if we could go through, I'd like to have Lynn, I've given you the 5-second introduction. If you could spend a couple minutes and talk about yourself and your brief background, and then later we'll get into some questions for everybody.
Sure, happy to. Thank you, Jacob.
All right.
All right, nice to see everybody. Full disclosure, I'm on the East Coast and it's 7-Eleven here. And so maybe there's wine. So thank you all for having me. My company is Community 3. Our main office is in DC. We have an office in Miami as well. I choose to work out of the Miami office in the winter. I've been in the industry for over 30 years. I came up in the consulting finance side, and I learned that piece of it. I owned a company called Urban Pace, where we consulted for real estate developers. And I sold that company 5 years ago to Berkshire Hathaway. And I had another company, Allyson Capital, where we invested in, raised capital to invest in real estate deals, rentals and condos. So I learned the investment piece of it as well. And so my current partner at Community 3, I thought he was best in class. He's an architect by trade before he started the development company 13 years ago. And he is truly an expert in historic rehabilitation and adaptive reuse. And by the way, we have a brand new website that'll be launching next week. So we'll have a lot more cool pictures of our projects. Anyway, great guy. I invested in him, and we had such a good synergy relationship that we partnered up 5 years ago now. We are doing some really, really interesting projects. Just a quick mention of a couple that we're working on. We bought 4 office buildings in Old Town Alexandria, which is right across the Potomac River from Washington, D.C., for you all that are not familiar. And we're turning 3 of those into residential and mixed use, retail, and a large arts use component. So that's a very exciting project. And we are about 80% complete on construction. We bought a historic school from the district, a city disposition, and that is about 100,000 feet of office, apartment building, a condo building, some retail, and we're building the African American Civil War Museum. So just an example of we're doing a large workforce housing project here in Miami that we're excited about. So yeah, we're having a good time, and thank you all for having me.
All right, thank you, Lynn. That was a great intro, and look forward to all the questions that we will ask and have you guys answer. Next up, if we could have Tom Lucid introduce yourself and kind of go a little in depth on what you're working on and your background. That'd be great.
Sure. Hi, everyone. Nice to meet you. Tom Lucid. I am also on the East Coast in New York. It is also 7:15 here, and I do not have wine, but that sounds like a great idea. I wish I would have thought about that in advance. As Jake mentioned, I work at Silverstein Properties. Silverstein Properties, as you may know, is most well known for the redevelopment of the commercial space at the World Trade Center in Lower Manhattan. However, we've expanded in business lines dramatically and in geographical footprint over the last decade or so. And we've expanded into the debt space. We've expanded into doing fee development, core acquisitions, which has always been part of the business. And then starting to explore other markets. We just purchased the US Bank Tower in downtown LA late last year. Have a project in Vegas. We're also doing some work in Seattle. And specifically, some of the things that I've been working on directly have been a multi-family project in Las Vegas, not on the Strip, but near the medical district. And then most recently, Silverstein Properties was just awarded the RFP through Empire State Development and the Port Authority for the redevelopment of the last site of the World Trade Center, which is 5 World Trade Center, which is the old Deutsche Bank building that was demolished a few years after 9/11. We are partnering with Brookfield and an affordable housing partner named Omni New York and DeBar Development to develop that site into a mixed-use 1.345 million zoning square foot residential and commercial office tower with 25% affordable housing. And I've been with the Silverstein organization going on 10 years. I've been in the business about 17 years. Before that, I was at Starwood Hotels for a period of time and at JP Morgan in the investment banking side, and then on the real estate investment side at Starwood, and now on the development side at Silverstein. Jake, you're on mute.
Sorry about that. Thank you for the introduction. Appreciate that and look forward to hearing more from you. Next up, we have Tom Safran. If you can introduce yourself, give a little more detail than what I was able to uncover, greatly appreciate that.
Thank you, Jake. I've been in business, it's going on 52 years this year. Starting in Chicago, where I grew up working for HUD for nearly 5 years in the Chicago, LA, and Washington, DC offices. And in '74, I left and started my own business, specializing in, back then, Section 8 projects, and most of the time doing affordable housing. Occasionally we do an urban redevelopment market rate project. We're doing 240 units in downtown Inglewood where the stadiums are happening. They've built a football stadium for the Chargers and the Rams, and the Clippers owner is going to build one there. And we're right at the transit stop for Los Angeles, the Crenshaw line that will go to LAX and head to downtown. So we decided to do that project with 50,000 square feet of retail, including 35,000 square foot Target. But most of what we do is affordable housing. And right now we're doing a range from partners with Actors Equity in downtown Hollywood, doing 150 units, which will include a theater and a coffee shop and an art gallery. And the entire building will be occupied by artists. We're also partners with 2 nonprofits developing the largest VA property on the west side of LA. And the VA selected us to do at least about 1,500 units of veterans housing, mostly for homeless veterans. So that's a range of what we do. And there has never been a better time for affordable housing in terms of the state, the county, the city, all in support of it, a tremendous need for it, but it's also the most competitive time. We create projects and then we find it really difficult to get funding for it because there's so many projects out there trying to get the limited funds that the state, that the different levels of government, state, federal, and city have. So it's the good times and the challenging times. I look forward to answering any questions. One more thing, vacancy. We usually have 100% vacancy collection lots. I mean, excuse me, zero. And right now, in this challenging time, we've been at 98%. But the state and the city have come up with funding to make up that. I think we're going to end up losing about 1/3 of 1% over the last year because of a state and federal program. Or excuse me, a state and city of LA program that will help us fill in that gap. So that's the beauty of doing affordable housing, because you don't have what I experienced. In one quick story, in 1981, I built my first and only condominium project. Are any of you around from that period that know what the interest rates were? When we finished the building, we offered the bargain basement rates of 15% for the buyers of our units. Needless to say, we didn't sell a single unit, and I never built another condo project, not knowing what the market would be by the time I finished it. So I have mostly stayed in affordable housing or an urban redevelopment market rate project.
Thank you, Tom. That was fantastic, and I didn't realize that was the going interest rate back then. Next up, we have Mo Bella, who will give himself a very brief introduction on his consulting firm and his background.
Thanks, Jake. First of all, to Mr. Safran, I was around then, Mr. Safran. I'm sorry to say I was. I was. First, thanks to Chris Fraley for inviting me to participate. It's, I hope all of you feel my heartfelt gratitude to all of you for your contributions to the industry and how much pride it brings me personally to just be among all of you experts and your incredible successes in your respective careers. It is amazing. I think a couple of basic things. One, as Jake kind of mentioned, I'm the first LGBTQ American to serve twice in the White House in a senior executive role. I was actually the CFO and senior advisor to Vice President Al Gore. And most recently, I was the Deputy Chief of Staff for Management and senior advisor to a man named Joe Biden. You might have heard of him lately. And so the reason I share that with you is because obviously, you know, with the president winning the election, things have become very interesting. I'm also of counsel at a law firm named Stein, Mitchell, Beato, and Misner in Washington, D.C. But as it relates to this panel, I was the former senior vice president at United Dominion Real Estate Investment Trust Company. I'm the former executive director of the National Association of Hispanic Real Estate Professionals. When I was recruited to go be the SVP at United Dominion, it was, as Jake alluded to develop a new multifamily strategy and model. And I coined it cultural customization. Again, as it relates to today, and we'll talk more about this hopefully in a little bit. Then I was focused on Latino development and culturally customizing multifamily properties across the nation. I went on to co-own a development company. We developed and we repurposed multifamily properties and culturally customized them, focusing on Latino tenancies. The good thing is for this conversation, I look forward to sharing some of those best practices because they apply to the LGBT community as well as other communities. So I'll just stop there, but I'm looking forward to the questions and I'm looking forward to the discussion and the impact of this pandemic and on the multifamily industry and other related topics. Thanks for having me, Chris.
Thank you, Mo, and look forward to hearing your answers as we come along. I was hoping maybe we could start off with Lynn and then Tom Lucid, and then kind of go from there on the next question. But I wanted to see what's going on in your markets and how have you had to adapt to the changes as a result of the past year and COVID-19. So Tom, if you'd like to take a bite out of that one first, I'd appreciate it.
Sure. So I think it's helpful to kind of describe the state of the market through some data points, because I think that speaks pretty loudly to the extent, the order of magnitude impact on what's happened in New York over the course of the last year. So I'll start, I pulled together some information that I was looking at the other day for 5 World Trade Center and for 30 Park Place, and I thought this was pretty timely. But starting with the for sale market, just a couple of stats. Real inventory is at rose 19% in 2020. This is condo, for sale, condo and co-op, the highest year since 2008, 13,400 units. Manhattan sales fell 25% in 2020 year over year. We're sitting at about 5 years of supply for new development and 2 years in the overall market. And the median price in the overall market has gone down 11% since March. That was as of Q4 2020. However, when you look at the last part of the year, we're seeing some positive trends. So in Q4 2020, it's been the strongest Q4 since 2016, and a 9% year over year increase in sales and 45% quarter over quarter increase in sales. On the rental side, obviously, this has had a dramatic impact in the multifamily space in New York. Most of these statistics that I'm quoting are Manhattan, because we tend to focus primarily on Manhattan as an institution. Visible vacancy in New York City, which is basically what you would see through public data, is at the highest it's ever been at 5%. However, that's just visible vacancy. Real vacancy is anywhere between 15 to 20%. And 35% in some buildings, particularly the newer buildings. Rents are down double digits. Rents are at an 8-year low and 40% year over year decline for the market rate rentals. And unemployment in New York pre-COVID was 3.7%. At its peak, it's at 20%, and right now it's sitting at about 12.5%. However, there's some good things, the same with the for sale market, that are on the horizon. For one, unlike the condo market, the supply of new rentals in New York overall, specifically Manhattan and in prime Brooklyn, is constrained. So there's not a lot in the pipeline. And if you look at the lease volume year over year from 2020 to from 2019 to 2020, starting in October, the pent-up demand was showing, and leases were actually up 60% year over year in October and December of 2020 compared to 2019. We don't have data available yet for 2021 for Q1. However, based on evidence that we're seeing in our portfolio in Silver Towers and River Place, which are combined about 2,400 apartments on West 42nd Street in Manhattan, we're seeing a significant uptick in leasing and traffic and in leasing volume, really starting toward the end of February and into March. So I think there is definitely some good news on the horizon. As we all know, we have a lot of the uncertainty that was kind of hanging around for 2020, both politically and with the pandemic and economically. Seeing a light at the end of the tunnel, or at least some path forward. And that has had a significant impact on the way people are perceiving living in New York. So obviously a lot will be predicated on employers and when they will be requiring people to come back to the office. But given that rents and condo and co-op prices are sitting at lows, all-time lows in recent history, people are starting to realize that this is an opportunity to transact. And if you want to lock in a decent rent, you should probably do it in the next month or two, because people are going to start coming back into the city over the summer. And based on what I'm seeing, most employers are saying that they want their employees back in September. So that's sort of the lay of the land here. I hope that answers your question.
Yes, yes. What have you seen with asset valuation? Because we in LA have seen somewhat similar in the sense that vacancy, particularly south of the Hollywood Hills, west of the 101 and west of downtown Los Angeles, very high vacancy, where you had more renters by choice. And personally, we've got, 3 buildings that we're leasing up, all that are luxury buildings, renters by choice. And it's interesting which ones are leasing up faster. But we've had to come down on our rates about 15%, and in addition, give 2 to 3 months of concessions to get some velocity there. However, when I'm out buying new buildings, I haven't seen an adjustment for that in the valuation. You're still seeing pre-pandemic, maybe a little bit decrease. You could pick off 1 or 2 assets here or there, but valuations seem to be staying the same. How is that going for you in New York?
I'd say it's similar in New York. I think, if you don't have to sell, and people who are selling now are most likely distressed sellers who need to liquidate for one reason or another. So most people aren't selling. I think the vacancy rates that you've been quoting are similar to what we see in New York. And a lot of what's been happening is I was talking about visible vacancy, but also the rental levels. You have to look at the gross versus the net. And most landlords are very focused on maintaining the gross rent numbers. So they're offering concessions. I've seen up to 5 to 6 months in some newer luxury buildings that are not in prime neighborhoods or are on kind of the periphery of prime neighborhoods. So there's been this trend of, flight, upgrades, people wanting larger space. You could get a 2-bedroom this year for what you would get a 1-bedroom for last year. So why not upgrade now? You could go from, a pre-war building to a brand new glass tower for the same price, or maybe even less. So why not do that upgrade now? So there's been a lot of that, but to your question specifically about asset value, you're right. I think most people are not willing to transact right now unless they absolutely have to.
Okay. Lynn, what are you seeing in Washington, D.C. and Miami?
News and end with the good news. By the way, Tom, I've been telling people 6 months that if they've ever wanted to buy in New York, now's the time. I think time, and I think if you ever count New York City out, you haven't paid attention.
Is anybody else having difficulty hearing Lynn? Is that just me?
I am.
Okay.
And it sounds like it's, yeah.
Lynn, I think there might be something a little off with your microphone or your Wi-Fi maybe.
Sorry about that. I've been on this thing all day and had no issues. Can you hear me okay now?
No, it's still a little
painful.
Do you want to, how about this? Do you want to log out? We'll have Tom speak next. If you can please.
Let me try to figure it out.
Okay. In the meantime, Tom Safran, can you chime in for us? I appreciate that.
Well, everything, the market rate, affordable housing is a whole different market. Just by the way, we are partners with the Gay and Lesbian Center in LA, and we're building for the longest period of time. Make sure you guys hire, ladies, gentlemen, hire the best contractor. We didn't. We're not our own builder of larger new construction, and we're doing a senior and youth housing, and it should have been done a year ago. So I don't know who's been impacted by the virus, but this project, unfortunately, has been greatly. The same thing that Tom and you, Jake, said, I've observed in prices. I haven't seen land prices or building prices. Nothing has gone down yet. And I think people are holding on. And for those who haven't been around as long as I have, property used to sell with a set price and you negotiate and you come up with a lower price. This is all new from the last 5, 6 years, 10 years well, no, it's 5, 6, 7 years after the 2008, whatever we call it, recession, that price property are listed for best offer, and you might be invited to the final round. Never been anything like that. And so I'm still seeing that, and I've never seen such high prices as for affordable housing. Buildings that, to give an example, I bought a 3 and 10-story building in Orange County in the city of Santa Ana 23 years ago for $12,000, $60,000 a unit. And we repositioned it easily with approval from all the parties at $300,000 a unit. And that's below the market for a 1-bedroom in that area. So what's happened in value of apartments, that's been, from my experience, the best industry, and why one of the reasons we're having this seminar today, because apartments have been the best thing to invest in. We're listening to Tom in New York. You're talking about office buildings, what's happened. The comparison of apartments and office buildings, except for maybe industrial in certain markets, retail, of course, has crashed in so many markets, shopping centers and office buildings, but apartments, people need housing. And if you're in that right market area, which Los Angeles certainly has been, and so has New York in the past, the value has gone up dramatically, and putting deals together is that much more challenging because of how you have to buy the property and how much you have to pay for it, whether you're buying an existing building or buying land. So, Jake?
I agree. It's hard to get stuff to pencil here, Tom. It is very, very hard, but I think that's true probably in New York as well, any hyper-competitive market. I will say, touching back with what Tom Lucid was talking about, the interesting thing here in LA is we are having renters, particularly renters by choice, trying their best to opt out and buy houses, but the housing market here has been so competitive. We haven't really seen the purchase. If you want to buy a home, the prices here have not come down. Matter of fact, they've gone up over the past year during the pandemic, which has been particularly interesting. And they're actually the highest increases that I've seen have been out in the valley, where people want to have the yard and they want to have a little bit more space, and they maybe don't want to be as friendly with their local homeless person. So, but Lynn, are you, I see you are back on. Let's try. Second time's a charm.
Okay. All right. Can you hear me?
Much, much better.
Yes.
Much
Okay,
better.
great. Who the hell knows? Anyway, thank you for the tip on chat, by the way. All right. So what I was saying is, Tom, I've been saying for over 6 months that if you've ever wanted to own a place in New York, now's the time. I think if you count New York City out, you haven't paid attention. So I would expect that market to, by the way, we have an apartment in Chelsea, so I look forward to meeting you in person, hopefully. All right, so Washington, D.C. Washington, D.C. is a really interesting market. It's a tale of two cities. The for sale market has been on fire. There is literally no inventory if you want to buy a condo or a home in D.C. The rental market is abysmal. It's the very similar vacancy rates as Tom said in New York. New York, DC is a unique market in the sense that it has a significant number of Gen Zs and millennials. DC is the classic, you graduate from college, and one of the best job markets in the city is DC. And so we always have a significant number of demographic in DC under 35. So unfortunately, what's happened in the last year is that demographic, as everybody on this call is aware of, are the ones that moved home with their parents or have relocated to rent a house with friends in Hawaii or whatever the case may be. So the rental market in DC is very, very difficult. what needs to happen is exactly what Tom said, is, people's, business owners need to get people back in the office, and clearly that will help mitigate that issue. But I think the rental market in DC is tough for the next couple of years, is my prediction. In the city, the DC has really been on lockdown, not just COVID, as everybody is aware, during the inauguration and, all the political issues. It's been a very, very difficult time for DC. But based on what's happening in the for sale market, people, still believe in the market, and they think now is a good time to invest. And DC will absolutely come back. But it's been our rental portfolio, it's been very, very difficult. Now switching to Miami, that's a whole nother world. We are daily getting a huge influx of corporations, business owners relocating to Miami, primarily from New York, and secondarily from California. Miami is trying to rival itself as the tech city on the east, and there's a whole area of Miami called Little Haiti where they're doing a mini Silicon Valley, and so it's been on fire here, and you can't get a single family home in Miami right now. Miami was oversupplied on condo before COVID, so there's still some supply and that type of product, but for the most part, the market here is very, very strong. And it's interesting, Jacob, what you were saying, and Tom, about deals penciling. That's what's difficult for us right now. We've always had metrics that we run deals by. We don't change the formula in Excel to make it work. So, we stick by, but it's very, very difficult, and you can't come close to getting the IRR returns on deals that you could 5 or 6 years ago. It's not feasible. And so that's the biggest difficulty that we've had, frankly. And as you already talked about, assets are not going mark to market, which is really frustrating. You're not getting an accurate, cap rate valuation, based on the NOI. And so, it's a difficult climate for new deals. But all in all, we feel very lucky to be in the markets that we're in. And the idea that cities are not going to come back, I think is just a false notion. Now, some cities are going to take longer than others. But before COVID, many cities right now are the best that they've ever been. People like living in cities. They like that interaction. They like being close to their job center. That part of human nature is not going to change. I really believe that when people get called back to the office, which I think is as late as September, I know many now, with people being vaccinated much quicker than anticipated. I know a lot of people that are calling back to the office in June, July. So I think cities are going to reemerge quicker than I think anybody's predicting at the moment.
I agree. And thank you for that. Mo.
Can I just add something on that, Jake?
Yes, absolutely.
I actually, I've done over 100 interviews in the last 12 months on remote workforce, because I'm on the board of directors of a company that is a SaaS company and has a remote workforce management software. And I just want to say something about how quickly, Lynn, I think these cities are, I don't disagree with any of you guys are the experts. I defer to all of you on asset valuation, availability, and all such. I think that what we might be underestimating is the number of people who are actually going back to quote unquote job centers. I think remote workforce models are here to stay. If you will watch Apple and Google and the big Silicon Valley firms, you see them moving to what I've been calling in the media a hybrid workforce model. this will have a direct impact on multifamily housing, in my opinion. I'll leave it to you experts to determine what that impact will be and how it will, affect the luxury versus the affordable market and so on and so forth. But I think we're underestimating which cities are going to bounce back. I think it's going to be cities that are walkable, affordable, where people can go back to now and work remotely. Because this is the second thing I'll say on this topic. Every study and all the research I've done on remote workforce management is demonstrating that employees of the future are going to demand the option to work remotely as part of their benefit package. I may be proven wrong, but that's what all the patterns in the data is showing, right? And so I just point that out because I think it's going to directly impact the multifamily housing industry. At least that's what I said at the multifamily housing executive conference in November. So we'll see if I'm right, but I just wanted to point that out, Lynn, because I think it directly affects everything we're saying here about New York bouncing back, Miami, DC, LA, and so on. I say keep an eye on the Kansas Cities of the world and St. Louis's of the world, the Dallases and the Houstons and the Austins, right? I think people are going to go to cities they find charming and exciting and affordable because they get to work from home now.
Yeah, I agree with you, Mo. I'll add to that I also think whichever cities have an easier jurisdiction to work with and to set up businesses will also be the winning cities. I think, but as a native Californian who's lived here my whole entire life, I will say there's always been waves of people, upset and leaving town, peeling out as fast as they can. And 2 or 3 years, they come back. Now, the difference is this time, in the past, that was maybe just a California thing. And now I think that this has happened across the nation and all cities. So it'll be interesting to see. But I think both you and Lynn touched on kind of one of the next questions that I wanted to talk about, which was, when do we think renters are going to return to our cities? And so I think both you and Lynn have touched on it. If we could hear from both Toms, that'd be great. So maybe start with Tom Safran and then follow up with Tom Lucid.
I'm going to pass on that only because nobody has moved out of our buildings because they're affordable. My 2 market rate buildings, they didn't leave either. So I'm not clear in Los Angeles about what's happening. I haven't seen that. So pass to you, Tom.
Well, I think it's already happening. I think we're already starting to see signs of it just based on the data that's coming in from, first quarter. New York is a fun place to be in the summer, and a lot of people left. Let's just talk about numbers again quickly, because I think it helps tell the story. Over New York City is around 8.6 million people in the 5 boroughs. 600,000 people left in the last year. And of those 600,000, roughly half of those are people who just left to go somewhere else indefinitely. And another half of those people who still have homes in the city, but have gone to the Hamptons or upstate New York or somewhere like that. The 300,000 that didn't have a secondary home, I think, are who we're starting to see come back. And again, it's largely dependent on when employers are going to require people to come back to the office. And I do agree that it's going to be sooner than we all thought. But I also think people are just bored of being isolated. And, I don't really have data to support that, but, I live in Manhattan in the West Village, and it is tangible, the level of energy that you see increasing on a daily basis on warmer days versus what it was in November, December, January. You can see people are coming back. You can see restaurants are starting to fill up. You can see people who are on the park even on cold days running down the West Side Highway. So I think it's happening already. And I think, I 100% agree with Mo that, you know, this is never going to go back to what it was pre-pandemic in terms of the work style, working from the office Monday through Friday. And I do think the hybrid model is the future. But I think there's a real desire for people to want to come back to the city, to want to go to a Broadway show, to want to eat at a restaurant outside and see their friends. You know, so I'm pretty confident that this is going to be a very energizing summer for the city, and hopefully it carries on into the fall as we see more people coming back to the office.
I just want to make a comment. Tom, thank you. I have a daughter and son-in-law who are living in my house in Park City. They each have jobs in New York City, and they are going April 1st. No fools, but they're moving back to New York, and they have been away for this entire time. And they are looking forward to it, and they talk about it with their friends.
Yeah.
Similar story. My office, we have about a third of we have 300 employees total, but we have about 45 who work in our office building. And a third of them are going to be permanently at home and only come in every week or two, 1 day a week. That's the deal we've worked out with them, because LA's traffic is returning to normal, still not quite as bad as it's been, or normal. And so that's our own personal experience. So that will change dramatically, but people are going to stay here, but they're going to have to be able to come to the office, but not daily, once a week, once
Right.
every 2 weeks, depending on their job.
Yeah.
That's our model. And I'm hearing that, and my daughter says that's the case, and my son-in-law, the case in New York. They want them back Labor Day. That's the current agreement. But they're going to be moving in April because they're looking forward to be in the exciting city that New York is.
Yeah, and we're definitely seeing an uptick of people coming in April, and landlords are also being more flexible with start dates for leases. So we're accepting leases at some of our buildings for June 1st right now, because we know that people want to come back, but maybe not quite yet. And you know, that's not something that we would have entertained pre-pandemic, but obviously something that we're willing to entertain now.
So a couple points on, you know, this discussion, people coming back versus not coming back. I mean, because clearly the technology advanced much faster than it ever would have without COVID, and the ability to do remote work now is, you know, is much easier than it was. Okay, so there's no question about that. And so the infrastructure is in place. So I do think there's certain industries where it's easier to work remotely. And you will see more of that. There's no question. However, I think, you know, at the end of the day, we collaborate, we get creative, and we interact in person best. And I think the most successful companies will still have in person. So what I think will happen is over the course of time, the companies that they're doing the best still have a lot of in-person office and that type of interaction, and other companies will realize they're behind the 8 ball because they have more of a remote work model, and you will see that shift back somewhat. I think the point Tom made is spot on. I think what happens in the future is definitely more of a hybrid model, and frankly that should have happened before. I mean, why do you have to take PTO if you're, you know, you need to be home to, you know, have the cable person come by, right? I mean, or whatever the reason. So clearly that's something that should have already happened. And I think that will be part of the benefit package. I agree with that. I also think you guys, you know, you have to bifurcate people at the top and people that are just starting out. You know, the reason we've all had managers forever is because we need management, and, you know, remote work doesn't really offer that. And, you know, out of sight, out of mind. So I think there's a significant number of people that need to be in the office for a variety of reasons. And the last point I wanted to make is that, you know, there are certainly more affordable cities, but, you know, you have to want to live in Cleveland. You have to want to live in Kansas City. No offense to any of those cities, by the way. I have some very close friends who live in Kansas City, but if you want to live, if you're a New Yorker or you're a San Francisco person or a DC person, that is a very different living experience to live in those places. And so it's not just about affordability, there are a lot of other factors.
But that's what we're seeing, isn't it? That's exactly what we're seeing right now. People are going to those places because it's affordable.
But Mo, what we're seeing right now, though, is not the real world. I think that's the point I'm making. Okay, nobody's in the office right now, so they have the option.
I'll interject here. I kind of agree with both of you. I agree in a hybrid model, and I think that definitely you have to have people at work. I know personally we've noticed, there's certain people who've been more productive through this working at home, and there's other people where you're on the Zoom call and you're like, have they even paid attention all week? And I remember, not to date myself, but I want to say it was back in right after the last recession, Yahoo brought in a CEO from a Google executive, and she got rid of all the work from home because she realized how inefficient it was and how the abuse that was going on. So I do think it's a hybrid model. And I do think that what this pandemic has accelerated is the inflection point of, is this city going to work for me? Do I think I'm going to make XYZ dollars, which is what it takes to make it in New York, San Francisco, Los Angeles? Right. And if I don't, hey, Denver's great, and I can buy my dream house for $900,000. Whereas in LA, San Francisco, New York, I need $500,000 to $1 million for the down payment, depending upon which city. So I think I definitely agree with both of you on that. And that kind of,
by the way, Jake, Lynn was, I just want to say, Lynn is spot on. The only thing I would say, Lynn, on the technology point that you made, you're right. It's a new normal now, and we do have the technology. I sit on the board of a company that has remote workforce management software. You don't have to be there anymore for knowledge workers.
Yeah, but no, I said the technology is there. I agree with you on the technology.
Yeah,
but the technology is not the human. It's not the human factor.
It's not. But what we've proven through this pandemic is I can show you data for hours that we've collected as a remote management workforce software company that will show you, you don't need to be in person to be creative anymore. We don't need to be in person to manage each other anymore. That what this pandemic has proven is that we have the technology like ours and lots of others like ours and related, right? Including the very technology we're using in Zoom. Where we
I'm flying to DC in 3 weeks because we're having a real issue with creativity and collaboration. So, we'll have to agree to disagree on this point.
I completely agree to disagree on this one. Lynn, I'm in your camp. No offense, Mo. But let's move on.
I just say to all of you,
hey Mo, listen, I'm buying your software, man. I'm sorry. Send me the invoice. I
just promise you that if you and I had a little wine, we could be just as creative on a Zoom call as we could in person. I can go to the bank.
Oh, honey, no.
Yes, we can.
All right, so let's move on that note. Let's move on to, we're about 5 o'clock. I'm happy to go over. I understand people might start dropping off.
Yeah, I apologize, you guys. I actually have to get on another one of these in 1 minute. So great to meet everybody. Mo,
Lynn,
I'm coming to drink wine with you in person.
I was going to say, and Lynn, please go refill your glass for the second panel.
Lynn, thank you very much for your time. I really, really appreciate it.
All right. Great to see you guys. Take care.
I'm more than happy to stay on, but I understand some people might have other things to move on to. But if our speakers are willing to talk for another few minutes, I'd greatly appreciate it. And if anybody has any questions, feel free to direct message me. Otherwise, continue on. I just have a couple more topics I'd like to touch on, if that's okay with everybody. Does that work for?
Works for me.
You, Mo, and Tom, the Toms. All right.
I'll stay on. I don't know how much I can contribute, obviously, because
All right, well, I'm going to ask you the next question then, which is,
these guys are such experts in development and finance and such.
but you have a great perspective on things, Mo, and which I learned from talking from you the other day. And so I'll ask Mo this question first, and then the Toms can figure out who wants to answer it next. And that is, what markets are you most excited about going forward? And we can talk about this, whether it be the specialty different cultures, or whether it's a hot market such as Denver or Nashville, etc. So,
well, you know, both actually, both are very exciting to me, and I'm focused on both of those, both geographic markets. But I was excited to hear Mr. Safran talk about what I mentioned to you, Jake, that I'm working with a couple of gay brothers right now that are both, one's an expert in the senior community, and another is an expert in developing and repurposing affordable and and market rate housing. We are actually, Tom, Mr. Safran, we're looking at some senior housing for LGBTQ seniors, market rate and affordable, because we think that there's a dramatic underservicing of LGBTQ seniors who are working class seniors, right? Wealthy, retired gays and lesbians can go, go to the luxury stuff that Mr. Lucid is developing, right? But the average LGBTQ retiree and senior coming into that category, it doesn't necessarily fall into that social economic strata. So I was happy to see that. So Jake, to answer that is, I'm very excited about LGBTQ senior housing, which is in direct correlation to my cultural customization that you referred to when I started 19 years ago at United Dominion and became a developer of that type of housing for Latinos. And before I jump off, let me say to Mr. Safran, you're sitting in a very sweet spot, because the one thing I know about my old boss and my dear friend Joe Biden is you're going to probably have the most supportive affordable housing administration arguably in the history of the United States under Joe Biden. And I think that that is very optimistic from the affordable housing perspective. And so I'm excited for you and all the things you're going to accomplish in the affordable housing space. You're going to have a friend in Washington, as you know. And so those are the only two things I'll say. There are a lot of markets like Denver and others, Jake, that I could go on and on, but I can't compete with Tom Lucid's incredible data, for God's sakes. He is prepared, damn it.
That's why we have him on here.
Exactly.
The rest of us look good.
The story through numbers. No, I mean, we're, I'm sorry to jump in. Is it my turn?
No, I'm done.
Moderator. In terms of markets that we're excited about, I mean, historically, we've been focused on New York, and we still are. We started Silverstein Capital Partners, which is a lending arm. And, we've kind of found a way to play in New York in a different part of the capital structure, whereas before we would be the developer and an equity investor, and now under Silverstein Capital Partners, a few of our initial projects have been large, complex, mixed-use condo buildings in Tribeca in downtown Brooklyn, where it's probably a less experienced sponsor. They needed some help with their construction financing, and they couldn't get the leverage that they wanted. And so we stepped into that to try to hit the returns that we would like to get on the equity side, that we used to be able to get on the equity side. And then in terms of other markets, we mentioned Austin. We're doing a deal in Las Vegas, which had really high rent growth pre-pandemic, among the highest in the country, and actually had continued rent growth even through 2020. And Seattle, particularly the Bellevue area, is another area we're very bullish on. There's a lot going on there in terms of just Amazon alone, and then some of the other tech giants have really made that, I think, one of the hottest markets in the country.
What, because we did have a direct question about this, what secondary, like non-coastal cities are you interested in, or are you pursuing? And this applies to everybody, all the speakers on this call. Tom, do you want to start? Tom Lucid?
Oh, sure. I think as an organization, we tend to not focus on secondary markets. We try to stay in, key gateway cities. It's just the preference for, at the end of the day, Silverstein is a family company that has different capital partners. And most of the time the preference is to be in markets that are as liquid as possible. And it's harder to do that once you go into secondary cities. I think, I don't know if you would call Austin secondary city anymore, but it's not on the coast. And it's a market that's been really interesting for a long time. And you guys mentioned Nashville earlier. That's an obvious one. We started putting Atlanta on the radar, which isn't the secondary city, but it's another one that we haven't historically looked at, but has some interesting, fundamentals in terms of just employment and continued demographic shifts that we think are interesting for development.
Okay.
I just make a comment. First, Mo, please call me Tom. Thank you. If anybody here wants to do housing for the gay and lesbian community, let me just a couple comments because you mentioned that. The project that we're doing, we got money to build it we bought the land in the heart of in Hollywood, and the land was expensive. Ideally, we would have gotten the land for free. But the fact that we bought the land added to our cost of building and capital that we needed. And we had great difficulty getting the funding from the city for this project, in spite of having incredible support from the county supervisors and the city council. In so doing, we got money from the state, the feds, the county, and the city to build this project. And in spite of that, our rents are too high. The only way you get affordable rents is if you get vouchers, if you get the old Section 8 program. That's the only way we're dealing with homeless housing. If we build a project with free land in LA and do a 3-5-story building, our rents are going to be $500 to $1,000 for a 1-bedroom. That's with tax credits and funding for that project. Homeless can't afford that, and all of the great number of the gay and lesbians that applied to our building can't afford that. So the Gay and Lesbian Center is looking at subsidizing some of the tenants who are moving into our building. How do you do that legally with fair housing? How do you fill the building up with gays? I'm gay, my partner is the Gay and Lesbian Center, but when we get money from these different agencies, we can't restrict it to gays. We can't have a blank on the application. And I don't even want to get in all the details. So I have a very disappointed partner because I can't tell the director and her board that we're filling it up with gays. And so we're going to be having other people in the building, and hopefully they're all gay friendly since they know where it's located and the partner. So giving you that background. In terms of markets, watching this since 1969 when I started, where's the market? To the West Coast and the South. I grew up in Chicago. I spent my first couple of years working for HUD in Chicago, working in the Midwest. And I visit those cities and see what's happened. Other than New York, Boston, Washington, it's got a given market, head south, head west. And then I say to people, know your market, because I've stayed in California, and at this point, we're only going Fresno, the Central Valley, to San Diego. Why? Because we can drive there. We've had fires. We've had murders. You need to be on site quickly. You need to have local people. And so to develop, when you don't know the market, I know the LA market so well. 12 years ago, we bought 812 units, a package from a developer, and 5 of them were affordable housing and 3 were market rate, not affordable, but affordable by the the character. And I beat out Aimco and the biggest people in the business because I put up $1 million non-refundable, 60-day, no contingencies. Now, anyone in this business, that's what has happened. In order to buy stuff, you have to be incredibly competitive. I closed that deal in 60 days, and I only saw some of the buildings, like 5 of the 8. I didn't even visit 3 when I made that offer. Why? Because I know the market, because I've lived it since the day I arrived here working for HUD. So I can't emphasize that enough to create success, to know, Tom, you lived, work in New York, you know that market, you know what you're doing. So anyway, that's my comment.
That's fantastic, Tom. And I agree with you on know your markets. Some of my favorites, which I'm actually convinced James over here to go in a couple weeks, we're going to go take a look at, is Phoenix. I love Phoenix, but my dad is from there, so I grew up as a young kid going there. It definitely can go way up, way down. I love Denver because when you go there, especially during the summer, people are happy, and there's beautiful green parks everywhere, and you can buy your dream home or something close to it for, a little more than double your down payment here in LA. And I've heard a lot about Nashville, and I've heard a lot about Atlanta, but those are kind of some of the cities, that secondary cities, and I don't even know they've gotten so large if you can call them secondary cities anymore, but some of the ones that interest me. Have not started any developments there, but they're definitely ones. I think the most attractive about Denver is, one of the best things about LA and any of the major cities is you can pretty much get non-stop. You can hop on one flight and get to any other point in the world on one airplane. And that's highly appealing. Denver has that. Salt Lake City has that. Some of the other secondary cities are starting to get there. So we are way over on time, so I'll just ask one more question and try and incorporate a couple of the other ones that have come through and been asked. But as a result of the pandemic, etc., over the past year, how do you see changes in development going forward? And have you implemented, and does that include any technology changes? Are you guys going to change the way you do things going forward? I don't know, Mo, do you want to take this one first?
Then I'm going to go really quickly, and then I got to jump off. But let me just say to everybody, it's such a joy to be with all of you. And again, to Chris, I love you, and thanks for inviting me. Tom, both of you are brilliant. Great to meet all of you. So let me just say this. You just teed it up for me on cultural customization. Tom Safran just said, know your market. Let me add one thing, know your tenants. And that is the premise of cultural customization, right? So if they're Latino, if they're African-American, if they're LGBTQ, if they're seniors, if they're single moms, if they're inner city, if they're rural, whether it's affordable, whether it's luxury, whether it's market rate, whatever it is, know your tenants. That's the premise. And so, yes, I think post-pandemic, we've established, I don't think Lynn and I, we need to drink some wine together. We might agree at the end of that, but it is different now. People are working from home. They will be working from home in unprecedented numbers. If I'm developing today, if I was Tom Lucid right now, I'd be looking at what do I need to do in my developments to meet the needs of people who will be working from home more often, even if it's 3 days a week, right? So we have to develop in a way that adjusts to the needs of the new tenancy, right? So know your tenants, know their needs. And on my LGBTQ senior housing, when we do that, Jake, you can come over on Friday nights because we're going to have piano bar in the lobby.
It's gonna be in Kansas City, right? Because that's where you want to live.
You know what? You're gonna never let me forget the Kansas City comment, but I bet you if I start singing "Meet Me in" what is this damn Kansas City song, you'll be able to finish it for me.
I'm sure I will.
Bye, guys. Proud of
I
all of
appreciate
you.
it.
Awesome.
All right, so Tom Lucid, do you want to take this real quick?
Sure. So, Five World Trade Center, I think, is a good test case for this because we just were awarded it and we're just kickstarting the design process. So there's some fundamental things that we'll be looking at in terms of the residential layouts. Obviously, home offices are much more valued than they were pre-pandemic. So being able to plan your layouts accordingly to accommodate home offices, or even if it's, New York City apartments aren't notorious for being big spaces. So how do you get creative with areas that you can transform into a nook that could accommodate a home office? That's something that's pretty critical. And then, starting to study MEP systems, filtration systems. This was is an airborne virus. Hopefully there's no next one in our lifetime, but who knows what that will be. So there's, extra care to study what that translates into and how we could be more cautious, whether it's, exploring designations like well, or, just trying to implement new best practices for that type of thing.
That's great. And what about any technology? If you guys made
Yeah, I
any
mean, that's a very good question. That's a big
timid on technology, like
yeah, it's and it's extra challenging with something like Five World Trade Center because we have a 1.5-year process with the state to get our entitlements, and then it's a 900-foot building which is going to take 3 years to build. So we're not going to be leasing until 2026, 2027, and so we have to really think about that because we're not delivering units this year. It's 5-6 years from now. So, whether it's, smarter homes and appliances, or, having everything controlled via, what type of app systems will there be? How are things going to fundamentally change? I mean, look how Amazon changed the way packages are delivered to buildings and the need for large package spaces now. What's going to happen with grocery shopping and grocery delivery? Is that the next, it's already started, but is that going to continue? And how do we have to think about the design for that? So I don't have the answers. I wish I knew, but it's something that we're going to be studying very, very carefully because there's a lot of trends that were accelerated through this pandemic.
Great, agreed. Tom Safran, do you have any comments on this?
No, thank you all for joining us today, and happy to answer any questions. Tom at tsahousing.com. So that's how you reach me.
We're not done yet unless you have to
Oh,
go.
you're not done? Okay.
No. We wanted to see if you had had any changes to your incorporating any new technology in your buildings as a result of the pandemic.
No, frankly, well, our market rate building, we changed the name to be more trendy, but we were under construction when the virus started. And all the other buildings I'm working on are affordable, and I'm being requested to save money and lower the cost. That the cost of building is too high. So these buildings are coming in at 500,000, 600,000, 700,000 a unit, apartment building. But the city imposes prevailing wages on us, which most of you market rate guys don't have to do. And then we also have to do project area. We have to hire and train workers. Well, each of those adds for our contractor 10 to 20%, depending on the building type, et cetera, to the construction. So that's why they cost more. So we haven't had a chance to do any of that. The beauty of the buildings, of course, we have they're all operable windows and individually metered, and we do put in community centers in all our buildings. So that's where we're seeing the working part of our residents, operate. They go outside, they sit outside in the good weather, and they work in the community rooms to get away from the people, from their family. But I want to just share a comment. We have 5-6 employees. Our office is closed, but we have about 6 employees out of 45 who come to the office regularly, even though we're still closed. And why? Because they have 1-year-old, 4-year-old children at home, and they can't work, and they want to come to the office and they want a break. So if you're doing a family project, There's, a great demand to go to the office. So where am I going with that? I'm sorry. I don't know.
Here, I will add my 2 cents here. So we just delivered 3 buildings, 2 of which are on the larger side, or larger for us, but probably peanuts compared to what Tom Lucid delivers. But one building's 88 units, the other's 96. And so we really haven't implemented a lot of technology. Where we have implemented is like smart technology. Part of it is we're in what I'd like to call the apartment.com shell shock, where we got convinced of, low, great marketing rates. Everybody's going to be on here. And now that we are, 9 months pregnant, so to speak, all of a sudden our $200 a month rates are now $2,500. They're not delivering that much leads, and our marketing bill, which was supposed to be $2,500 a month, is now $18,000 a month. So I have a little, shell shock with when it comes to tech. So, but what we did do pre-pandemic was stuff that would help ease the life of our managers, because this is a people business, and what we noticed over the past few years is labor costs were skyrocketing here in Los Angeles. So, for example, the individuals that go around and clean the buildings and fix the buildings and paint the units during turnover, we were previously paying them about $17 an hour. We're now paying them $23 to $25 an hour. So the technology we have implemented is all designed to minimize management. So, for example, we used to give out clickers to operate the gates. Now we have a system where you get a little RFID sticker and you put it on your windshield or on your headlight, and as you pull up, that opens and closes the gates. But the beauty of it is when you move out, the manager just logs onto their computer and disconnects you and says, "Hey, Jake LaJoie has moved out." And now as a result, their key fob doesn't work. They can't get access to the building. Whereas what had happened in the past was somebody move out and they'd lost a key fob to the garage, and now we have to pay somebody at $25 an hour for 3 days to sit there and reprogram every remote control of every other tenant. That doesn't happen anymore. We did the Lexer boxes because we noticed everybody was getting tons and tons of packages, and this was pre-pandemic. And that these packages are buildings which are in nicer areas were getting victimized. Our tenants were getting victimized. People would break in and they would go up and down the elevator and go to any floor they want and just take people's packages. So on our new buildings, what do we have? You can't operate those buildings unless you have a key, or the elevators unless you have a key fob. We have, lockers where you can put all your stuff in. We do have key fobs, but only on the front door. And then once you get within the unit itself, the only other thing we have technology-wise is a Nest thermostat. And then on some of our units with floor-to-ceiling glass, we have electronic window shades, and that's it. So that's my kind of 2 cents on where we are and how we've changed things, and particularly with technology. And I think that's about all we've got time for tonight, unless Tom Safran or Tom Lucid would like to add anything else.
No, thank you.
No. I just wanted to thank both of you guys. I've known Tom Safran for, I don't know, 8 or 9 years now, and I think the world of him. And Tom, I really appreciated hearing everything that you had to say. Especially, I really appreciate you doing all your homework and bringing in all the great data. And I wanted to thank both of you guys for your time. I wanted to thank once again Rio for setting up all the technology behind this, because without Rio, this wouldn't happen. And Chris Fraley, once again, for coordinating the East Coast, West Coast, and for bringing Greg out west when he moved out here to expand his family. So And also for all the LGREG members for joining. I know that this is late at night on the East Coast, and I know we all are very busy and can be doing other things. So I just wanted to thank everybody for participating. And if you guys have any questions.
Jake, just a quick question. The people online here, are they from New York and LA, San Francisco?
Yes.
Elsewhere?
All over, including Boston and Washington, D.C. But yes, it's LGREG members from all over.
Are there LGREG chapters in those other cities, or how does it work?
Yeah, there's one in Chris Fraley, if he's still on, can chime in. But we've got one in Los Angeles, San Francisco, New York, I believe Boston, and I think that they're trying to start Washington, D.C.
Got it. Thank you.
Yes.
Bye.
But on that note, I'd like to thank everybody and wish everybody a good evening, and hopefully love to see you guys all soon.
Good night.
All right. Thank you.
Thanks, Jake. Thanks, everyone. Bye.
Bye.